Hello, Linda and Andrew. Appreciate you joining us today here for our panel on cash and CapEx spending decisions. As we just heard from Ben, companies have been raising billions during the pandemic to shore off their balance sheets. They've also had huge cash piles thanks to good earnings in 2021. Linda, how is that looking for Nielsen? What does your cash balance look like? And also, when you're thinking of CapEx spending in 2022, what are the main priorities and focuses for you?
Yeah, thanks, Nina. A pleasure to be here with you all today and with Andrew. And I think probably between the two of us, you'll hear some similarities and some differences. Nielsen had been a company that had been slightly over leveraged going into the pandemic. And interestingly enough, during the pandemic, we actually sold off one of our larger operating divisions. So that has given us the opportunity during 2021 to do some delevering. And so we've been able to really proactively manage our balance sheet and our overall debt, liquidity, cash position on a very dynamic basis over the past couple of years, which I think has served the company and served our investors pretty well. And then as you look more broadly at where we stand from an overall debt perspective, going into what could be an interesting 2022, we actually have probably about something in the neighborhood of 80% of our debt that is in fact on a fixed rate basis, either issued that way or through use of interest rate swaps. So that too has us pretty well positioned. But we kind of look at it over a horizon basis and just step back and make sure that we've got adequate liquidity to support the business and to deal with our liquidity obligations and run the business in a very comfortable way, balancing the mixture of debt, equity. We also want to make sure that we've got sufficient liquidity on hand to be able to invest in our business or also do acquisitive, tuck-in type of acquisitions. So try to look at the totality of it and look at it on a horizon basis and are very comfortable with where we stand right now.
Okay, that sounds great. I'll follow up on a few of those in a bit, but want to give Andrew the floor to quickly talk about Foot Locker. Andrew, as you're thinking about cash and CapEx in 2022, what are the main things that you'll be investing in? And also, do you see CapEx spending going up compared to previous years?
Yeah, I think, just kind of giving you a picture of where we are and what's important to us. We continue to remain very focused on growing our business and making sure that our CapEx is very reflective of our investments and our initiatives to grow the business and growing the business both organically as well as inorganically. And so when I think about our organic growth initiatives, it's really around digital enablement with our consumers. It's very, very important to talk to our consumers and meet them where their decisions are made. And so the ever-changing environment, the ever-changing digital environment continues to keep us focused on growing our business through ensuring that we are engaging with our consumers in our digital channels. And when I think about our digital channels, that's part of what we think about as far as our total omni-channel. So therefore, you've seen us grow our business. Even during the pandemic, we've kind of grown our brick and mortar footprint, incorporating that in the full digital engagement with our consumers and thinking about that entire omni-channel journey that the consumer craves and that they're on. So growing our business in our omni-channels, both digital and through our physical footprint. We did take the opportunity, and we even before the pandemic, we were a company that opportunistically looked at the market for inorganic growth opportunities. Really excited about the two acquisitions that we made during the pandemic, and we announced this summer with Atmos and WSS, which were in many ways, businesses that that were in the same space and sectors we're in, but in different ways. They opened up different product assortments. They opened up different opportunities for us to reach a different consumer, and so we took that opportunity as well. And as Linda talked about, really around what the balance sheet looked like coming into the pandemic and what it looked like. We had a strong balance sheet going into the pandemic. We were generally conservative in our cash position. We had some old debt that was on our books. We took the opportunity to go to the market as many businesses did and lever up a little bit in debt. We went to the market and raised some debt, and we paid off some high interest older debt. And so coming out of this, and I use that term loosely, coming out of the pandemic, because it's been elongated, but coming into 2022. We feel really good about our cash position. We feel really good about some of the things that we've done during the pandemic with our 2 acquisitions, raising a little bit of debt at the same time, paying down the old high interest rate debt, and still being in a holistic position as you go into 2022 to keep the optionality open. And in addition, returning value to our shareholders as well, as we continue to run the business and generate cash at a pace where we were opportunistic to continue to raise our dividend rate a couple of times, not getting fully back to our pre-pandemic rate, but raised our dividend somewhat, and also took the opportunity to return value to our shareholders through share repurchases. All of that, coming into 2022, leaning into our share repurchase program, stepping up our dividend program, doing 2 acquisitions, getting some lower interest rate debt, paying off our old debt, and still generating cash through our operations. We feel really good about where we're coming into 2022, and continuing to. We're going to stay on strategy. The strategy being growing our business, opportunistically looking at both inorganic and organic options in the market, getting close to our consumer and investing in digital capabilities, getting close to our consumer, investing in our entire omni-channel offering, which includes our physical stores as well as our digital.
There was a lot in there, Andrew. Linda, just maybe touching upon a few of those points that Andrew raised, sort of investing in the business as well as M&A. Just wondering, sort of, if you look at Nielsen, you were also mentioning investments in the business in your last response. Sort of explain a little bit what the investment priorities are at the moment, and also if you're thinking about M&A, does 2022 look like a year where Nielsen could go out and purchase something in this market where we have a lot of very high valuations?
Yeah, high valuations are a little bit of a limiting factor at this point in time, and have been for the past couple of years. If I step back and I think first about investing in the business, we are in the midst right now of following what the audience views, and the audience is very much moving to more focus on streaming, sometimes through different means, through an iPad, oftentimes through an iPhone, and then also through smart television. And so we are on an initiative right now developing a cross-media measurement platform. And that, of course, is getting a lot of attention and a meaningful amount of investment right now as we step back and we think about our broader CapEx investments. And we didn't incrementally increase investments in order to make this, to have this focus on the cross-media measurement. Nielsen One is what it's branded as, but rather just did a reprioritization. And that's really a muscle that we've been working on throughout the pandemic, is just always trying to focus on what's most important from a prioritization perspective. And with regard to M&A, we're really looking at it where it can make a difference to an existing capability that we have, and thinking about adjacent spaces, and really looking at targets that can expand some of what we do or complement what we do, let's say in the audience measurement space, and doing it in a manner in which we refer to them as tuck-ins, and we're executing on that as well and really integrating. The company a few years back had not been as good about integrating, and we've got a real execution focus now as we think about a very disciplined approach to M&A and ensuring that we are doing that integration just to really make sure you get not only the potential revenue that can come through an acquisition, but that you importantly get the cost synergies that are oftentimes there if the integration is done. And so that's really a focus for us. But as you mentioned, a bit constrained from a valuation perspective and just trying to be smart about how we deploy capital and step back and look at the valuations and look at trade-offs between investing in our own business versus doing M&A. And then once we get within what we've put out there for a net debt leverage ratio, getting to the point where then we can think about return of capital, which we've not been actively doing aside from our dividend.
What is that range that you're targeting or working towards?
So from a net debt leverage perspective, in December of 2020, we put out a range of 3 to 3.5 times. And we ended the third quarter just north of the high end of that range. So we're starting to get into the realm of having potentially some capital flexibility. And we're, of course, in quarterly dialogue with our board on what that might look like, but not in a position to put any additional definition behind that at this point in time, but just looking at the range of options and in active dialogue with the board about what that might look like as we go into 2022.
Just wondering for the two of you, with the recent surge in cases of Omicron infections across the US and across the world, has this impacted at all how you're thinking about spending priorities and CapEx in 2022? Or is it that you've reached that stage where we've gone through a few variants where it doesn't necessarily lead to you making sort of abrupt changes to those plans for the year ahead?
Yeah, I think that
Andrew, maybe.
Yeah, sure. I think that you hit the nail on the head a bit. It's that we have been experiencing this, the ebbs and flows and ups and downs of the pandemic for almost 24 months, and obviously in that initial 3 to 5 months, there was a lot of anxiety from many organizations and many companies around how to react and conserving cash and things of that nature. But throughout the process, I mean, the economy has proven somewhat resilient, and the consumers, at least and definitely in our sectors, have proven very resilient. And so we have been focused on definitely the health and safety of our teammates and our customers, and following the CDC and as to how we run our business. And obviously from time to time it affects our business, and from time to time we've had to close stores and things of that nature. But we've gotten into a rhythm where we understand how to run the business and how to continue to optimize. And we feel comfortable that as we navigate through this variant, and there may be another variant, or there may be another swell, we feel confident that we've run this play a number of times, and following the CDC guidelines, protecting our employees and our consumers, and running the business in an optimal manner. We feel like we have learned as we go, and I don't expect that we will. We don't have any plans to make any drastic pivots in how we deploy capital as a result, unless there's some unforeseen happening with regard to the pandemic that right now we don't have built into our thought process.
Linda,
how's that with Nielsen?
Yeah, I would say there are definitely some similarities. If I think about how we're deploying capital and how we're doing that in supporting the day-to-day business, CapEx is obviously something that we manage very dynamically. And I would say during the pandemic, we've even upped our game, and we've introduced more rigor into the process, and to the point that we will, on a weekly basis, get together our product and technology engineers, representatives from our finance team, and from our procurement function in order to make sure that we're calibrating the lead time necessary. A portion of our CapEx relates to hardware and the hardware that's necessary to measure audience viewing. And with that comes lead times, especially in this supply chain situation that we find ourselves in. So the components that might have taken weeks in the way of lead time now take months of lead time. And what it's really done is a silver lining, I guess, of the situation would be that we've started looking more ratably at when those components come in and how we're deploying them into our equipment. And I would say that it has served us well in so much, whereas we might have historically had a bit more of a peak, a seasonal peak, we've tried to smooth out some of those seasonal peaks and be far more planful about it. We've also looked at ways in which we can refurbish some of the components, or ways in which we can, if necessary, sub in a slightly higher cost component if it's readily available. And so it's caused us to think and come together as a cross-functional working team in order to manage through the process on a very dynamic basis out of necessity. But we haven't really had any sort of equipment disruptions at all. And so it's working for us, and we're very pleased with the ability to develop this new muscle as one of the silver linings of the pandemic as well.
Andrew, how is that with you, with Foot Locker? Have you made any changes how you're thinking about forecasting, planning, as you're thinking also about budgeting for the year and for your cash due to the pandemic, or has this all largely remained the same as compared to pre-pandemic times?
No, I think that what the pandemic has done is it's really accelerated the consumer journey to an omni journey. So it's accelerated that process. The consumer, most of our consumers, their journey starts on their digital device, whether it be a laptop or phone or iPad. So it starts there. And so, and the trend was moving there. When the pandemic hit and the stay-at-home orders came in, it really just accelerated that evolution. So it's required us, just as many other companies, to really focus on ensuring that we are leaning into that omni journey and we're meeting the consumer where they make their decisions. So whether it be,
what does that mean, sort of, if you think of your forecasting and planning, sort of on the financial side for you as CFO, if you're thinking about cash planning, CapEx planning?
Yeah, and that's what I was getting to. So as we were in 2020 and 2021, really focusing on the disaggregation between our cash at brick and mortar from a CapEx perspective, our cash at brick and mortar, our cash related to our digitization and technology, focusing in on those areas, and customer engagement type spends have that started, and that will continue into 2022 with regard to making sure that our cash deployment from a CapEx perspective is focusing on those things that increase and enhance the consumer journey.
Yeah, that's good to know. Just one quick follow-up before I unfortunately have to wrap up, but you were both mentioning returns to shareholders and thinking about investment priorities with regards to that. Linda, I think you still have an existing repurchase authorization to buy back shares if the company wants, and if the management decides it's a good time. Sort of, how are you thinking about returns to shareholders in general, and also about buybacks? Looking at your stock, I think at the moment might be a good time in terms of where it trades in comparison to like the last 52 weeks.
Yeah, we do think the stock is at a low price right now, and so therefore a potential buying opportunity. But we're not in a position to really be able to provide any definitive plans on that. We are, as I said, in an ongoing dialogue with the board with regard to broader capital deployment across the range of options. As far as what still remains open on repurchase authority that the board had granted several years ago, we haven't been doing repurchases of late, in part because our leverage, our net debt leverage had climbed up a bit, and now we've been able to moderate that back down. So certainly repurchases would be among the range of options, but not in a position to really be able to put anything out there definitively at this point in time, and in ongoing dialogue with the board about evaluating the range of options.
Andrew, how do you think about buybacks? U.S. companies bought back a record amount of shares worth, I think, around 850 billion based on S&P last year. What is Foot Locker's take on this? And also, just to follow up on the M&A part, you agreed deals worth around 1 billion last year. What is your outlook for 2022 and M&A?
Sure. From a repurchase perspective, similar to Linda's point with regard to an existing authorization, we do have one out there, and we have been in the market. As you saw through the third quarter, we reported a decent amount of share repurchase during the third quarter. We unfortunately, in the early parts of 2021, we weren't able to be in the market for a number of different reasons. Most notably the raising of our debt and being in due diligence for our 2 acquisitions. But we are opportunistically in the market under our existing authorization. We definitely believe that our stock is a good value right now, and so to the extent that it makes sense for us, like I said, throughout third quarter, we reported share repurchases during that period, and we have an outstanding authorization right now that goes through February of 2022. From an M&A perspective, again, we continue. That's a growth initiative for us. We continue to look in the market for capabilities, things that make sense for us, things that are either additive from a consumer perspective, from a product assortment perspective, from a differentiation and diversification perspective, as bolt-on acquisitions, or from a capabilities perspective, because I think with the ever-changing environment in the consumer retail journey, capabilities and ensuring that you just don't have. Sometimes you don't have the luxury of building internally, and so the opportunity to survey the market for capabilities as well as bolt-on acquisitions, we continue to just evaluate the market.